Dividend investors, bonjour. This is Mike Héroux, founder of Dividend Stocks Rocks and passionate investor. I hope you're doing well today. Today we're talking about Broadcom, a very interesting company for both income-seeking investors and growth income-seeking investors. What I like about Broadcom is obviously its incredible yield, 4.5%, but also with a dividend safety score of 4. So basically, this company will provide you a great yield, but will keep increasing its payment. And on top of that, there's more growth to come. So let's dig inside this beautiful company. Now, you may wonder what Broadcom does, and it's kind of easy, they're doing radio frequency filter and amplifiers, right, for high-end smartphones. If you're a geek, you're probably say, well, duh, that's obvious, RF filters are used everywhere and they're super useful. But if you're like me and you don't know what it is, you have to do some research, right? So long story short, basically, Broadcom is improving connectivity across all devices. In a world where the Internet of Things and Bluetooth and everything is talking to each other and we always rely on our cell phone, you can imagine that having the best RF filters is crucial. So this is why they count really high-end clients such as Apple and Samsung among their portfolio. So what Broadcom offers is a way to get better connectivity for cell phones, but also for all kind of other devices. You can imagine that now that we have went from 3G to 4G and now we're moving to 5G technology, the RF filters get a more important place in the smartphone, and this also means that they get more bucks out of each cell phones. Now think about that. Broadcom is making money with each cell phone that is being sold. But all carriers want to give away new smartphones because they can hook their client on their subscription. So what is the best business model? To be the best high-end RF makers ever, and then being able to distribute that across all kind of cell phones that are actually being given away for almost for free for customers. So basically the demand is always strong for their products. But the beauty doesn't stop there. In the investment thesis, you realize that Broadcom is like the party mix of growth. They are acquiring business after businesses after businesses, and over 10 years they went from 2 billion in sales up to 22 billion in sales. You can clearly see it right here. Revenue growth is very steady, going all the way up. Right now, what you see here in the earnings trend is basically right now, it's not because that they had losses or they didn't do that well. It's mostly because since they do so many acquisitions, they have lots of adjustment to make. So you would better off looking at their quarterly statements and understand and look at the adjusted earnings per shares and EPS. Because there's a lot of movement there, there's a lot of accounting written, and you must understand that the company is doing well, and it's not because the profit is going up and down, it's actually constantly going up. You can see that the trend for the dividend is quite awesome, and then poof, you have your opportunity. Trades around 260, used to be over 300 bucks. You have a great opportunity right here just because of the COVID-19. Obviously, that is part of the risk. Don't expect an amazing year for Broadcom. The demand for cell phones will slow down. Most industrials with the Internet of Things will not go full speed this year either. So I'm not expecting a huge year for Broadcom, but I'm expecting a decent year. The technology is not going to be stopped by a virus, and in the upcoming years, it's still going to go forward. The other problem that you can have with Broadcom is, when a company keeps acquiring more and more businesses, you have two things that happens. The first one, they grow their debt level. So obviously, Broadcom has an appetite for debt, and at this point it will be hard to get more debt from the market because, investors are starting to get the thrill, and they're not sure that they really want to invest more in bonds and stuff like that. So it might be difficult for Broadcom to acquire other companies at this time. And their latest move, that was CA Technology, was a big chunk, several billions included. The market didn't like it that much. They didn't understand at first what they were doing, buying a software company when they're doing like analog stuff and RF filters. So it's not exactly a perfect and obvious mix for them. So we'll have to wait until see if they can generate that like synergies that they expected. But this always comes as a risk, especially when you enter a recession and then you just pile up a tons of debt. It might be a tough year for Broadcom overall. However, when you look at the dividend perspective, you may be freaked out with payout ratio at 172%. That's kind of disgusting, right? You say, oh my God, they're going to cut their dividend. But if you go back in the past 2-3 quarterly earnings, you're going to understand that there were a lot of adjustments that are not cash adjustment in their statements. And actually, when you look at the cash payout ratios, which we use actually the real cash that the company generates, we're at 48%. So basically that 4.5 yield that you get right now is highly sustainable. You can even expect more dividend growth. Last part of this analysis is the valuation. I'm not too keen on valuation, but when you expect a dividend growth rate of 7% at the first 10 years and then 5%, the potential for a dividend printing machine should be $320 if you expect to make 10% on returns, annualized returns on your investment. So basically, if you're looking for a place that you can put your money and earn a 10% returns in terms of dividend growth, well, you should pay that kind of like money printing machine about $320. So definitely there's some value over there. Forward PE ratio right now is at 11%, sorry, at 11. So we're not talking about a company that is crazy overvalued here. It's a decent value, great business, good growth models with 5G coming up, the Internet of Things, cloud services. We just need more connectivity. And Broadcom has this impressive experience, long track record of acquiring businesses and taking the best of those technologies, integrating them in their own model and make them profitable. So this one is definitely on my buy list. Great acquisition. It's just too bad I have too much tech stocks on my portfolio right now. But if you're looking for income and a decent level of growth, Broadcom should be on your list as well. Obviously, do your due diligence. This is not a buy recommendation. And I want to tell you that next week, I'll be hosting another of my free webinars. Last time we were 1,200 people that registered to that webinar. We're going to talk about what's going on in the market, how you can position yourself. Should you buy? Should you sell? Should you stay put? The market is crazy. We get so many bad news right now. And at the same time, we have a huge rebound of like 25% since the bottom as of March 23rd. So where are we leaving with that? What's the situation with the virus? How can you get more confidence in your trades and make sure that you make the right ones? This is what we'll be talking about. I have the link to register to the free webinar. There's going to be a replay. So just go in the comments. You'll see all the details over there. And until next week, stay invested. Cheers.